Due to the staggering growth the firm has been achieving on a quarterly basis, Nvidia has been dominating the stock market in 2024. This is why the market was eagerly anticipating the company's fiscal 2025 third quarter results. Unsurprisingly, the semiconductor giant's report, which was released on November 20, showed better than expected results due to robust demand for its graphics processing units, GPUs, which are used in data centers to train and implement artificial intelligence, AI, models. However, the stock has declined in the 2 days since the company's earnings, suggesting that investors' initial response to the news has been unfavorable. Does this indicate that Nvidia's ferocious rise has reached a snag? Or will the stock bounce back from this setback and continue to rise, giving investors additional returns in 2025? Let's investigate. Compared to the same period last year, Nvidia's record quarterly revenue of $35.1 billion in fiscal Q3 represented a 94% rise. The figure exceeded both average projections of $33.17 billion and the company's guidance of $32.5 billion. Nvidia's non-GAAP earnings jumped 103% from the previous year to $0.81 per share, much exceeding the average estimate of $0.75 per share. Nvidia anticipates fiscal Q4 revenue to reach $37.5 billion at the midpoint, so the forecast was the cherry on top. That was marginally more than Wall Street's $37 billion projection. However, there were two reasons why the stock fell during pre-market trade. First, compared to last year's reading of $22.1 billion, Nvidia's revenue projection for the current quarter would represent an approximately 70% year-over-year growth. That suggests that the company's growth has slowed down somewhat. Second, for the current quarter, the company has projected a non-GAAP gross margin of 73.5%. That number was 76.7% during the same time previous year. However, astute investors ought to think about ignoring these two aspects. Even though the company currently has a sizable revenue base, it is still expanding at a fantastic rate. Although slower than in prior quarters, a 70% year-over-year increase in revenue is nevertheless rather impressive when we take into account that AMD, its main opponent with a smaller revenue base, has been expanding much more slowly. Furthermore, the margin pressure won't last for very long. The production ramp of Nvidia's next-generation Blackwell AI processors is the reason for the lower margin the company is predicting for the current quarter. In order to fulfill the enormous demand for these chips, the company is trying to maximize output, which will have an immediate effect on profitability. Our current focus is on scaling to strong demand, boosting system availability, and giving our customers the best combination of configurations, as CFO Colette Kress stated during the most recent earnings conference call. We anticipate that gross margins will level off to the mid-70s as Blackwell ramps up. We anticipate Blackwell margins to be in the mid-70s once fully deployed. Since Nvidia claims that the demand for its Blackwell processors is staggering, the short-term margin pressure shouldn't last long. As a result, the company is rushing to scale supplies in order to satisfy the extraordinary demand from clients. The positive news is that Nvidia anticipates delivering more Blackwell chips in 2024 than it had first anticipated. The company notes that even in that case, there would still be a greater demand for these chips than there are supplies, and it will keep working to increase output in 2025. Going into next year, Nvidia anticipates that its Blackwell revenue will rise steadily with each quarter. In April of that year, it is anticipated that the quarterly revenue from chips manufactured using the most recent architecture will surpass that of the Hopper architecture. Nvidia should be able to sustain the robust rise in its sales and profitability in 2025 and beyond if the switch from Hopper to Blackwell is finished and the company is able to create enough of these chips to meet the enormous demand it is seeing. According to its fiscal Q4 estimate, Nvidia is expected to generate $123.5 billion in revenue by the end of the year. Analysts appear to have gained confidence from management's remarks that it can produce another strong result the following year. The graph indicates that Nvidia's fiscal revenue projections have increased. Analysts predict that the company's earnings will increase by an additional 48% to $4.27 per share in fiscal 2026. But there's a decent chance it can surpass Wall Street's projections if demand for Blackwell processors stays high and makes a sizable contribution to its top line. After all, Nvidia has continuously produced better than expected growth, surpassing consensus profit projections in each of the last 4 quarters. Investors can still stick onto their Nvidia shares or perhaps purchase more of the company, since Blackwell might help it continue that trend in the upcoming year. The reason for this is that Nvidia's current price of 33 times forward profits is comparable to the 31.3 ahead earnings multiple of the tech-heavy Nasdaq 100 index. Nvidia should be able to provide greater upside in 2025 if it can produce better profits growth and the market chooses to reward it with a higher valuation. Rehard Jark posted a positive thesis about Nvidia on Uncover Alpha's Substack. The bull's thesis regarding Nvidia will be summed up in this post. As of November, Nvidia stock was trading at $136.92. Nvidia has a forward P/E of 32.57 and a trailing P/E of 54.05. An outside look at a crowded data center that demonstrates the size and operations of the business. According to Nvidia's most recent earnings report, the firm has experienced exceptional growth, with total revenue of $35.1 billion, up 94% year-over-year and 17% sequentially. Due to strong growth in all areas, especially in the data center division, which achieved an astounding 112% year-over-year increase in sales to $30.8 billion. This performance above the $32.5 billion estimate. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video. The success of Nvidia's Hopper and H200 chips, with H200 sales contributing billions, was the main driver of this spike. In line with this, net income increased 109% to $19.3 billion, further establishing Nvidia's financial hegemony. Despite these remarkable outcomes, Nvidia's reliance on cloud service providers, CSPs, such as Amazon, Microsoft, Google, and Oracle continues to raise questions. CSPs accounted for half of the company's data center revenues, a percentage that hasn't changed in recent quarters. Nvidia's growth may not be sustainable given its substantial reliance on CSPs, especially given the capital expenditure caps placed on these providers that may prevent further development. Despite its continued success, particularly with its entry into consumer internet and autonomous AI, Nvidia's data center division faces difficulties due to its growing reliance on CSPs. There are worries that these CSPs won't be able to keep increasing their investments in AI infrastructure as their capex restrictions approach. Furthermore, CSPs will have to walk a tightrope between the expansion of their AI workload and investors' expectations for returns, as their free cash flow closely matches their capex. However, despite a major drive to provide a full-stack solution that includes GPUs, CPUs, and networking for supercomputers, Nvidia reported a sequential decline in networking revenue. Despite a 20% year-over-year rise in networking revenue, the segment's growth trajectory was called into question by the sequential decline. In response, Nvidia stated that when newer systems, such as Blackwell chips, start to ramp up, networking revenue is probably going to have sequential growth in the upcoming quarter. However, Nvidia's overall performance prognosis is made more cautious by this uncertainty. Nvidia's gross margin, which decreased somewhat to 74.6% from the previous quarter due to the move toward more expensive and sophisticated systems, is another cause for concern. As Blackwell chips are completely implemented by the second half of 2025, Nvidia expects margins to continue to moderate into the low 70s. Given the significant depreciation of older chips like the H100, which were once highly sought after, this slowdown calls into question the company's capacity to retain its premium pricing. As more affordable processors like the H200 and Blackwell on the market, Nvidia will have to contend with escalating competition and control consumer demands for performance and price. The change from concentrating only on pre-training for large language models, LLMs, to a more comprehensive focus on post-training and inference scaling is an intriguing evolution in Nvidia's approach. This shift raises the possibility that pre-training's incremental performance advantages in LLMs are waning, which is why Nvidia is looking into other ways to scale AI models. This change may bring forth new difficulties, particularly when it comes to the usage of synthetic data, which some experts doubt will be enough to propel AI forward. Nvidia's advancements in industrial AI, especially robotics, are accelerating in spite of these obstacles. Large manufacturers are now able to incorporate AI into industrial robotics thanks to the company's Nemo and Omniverse systems. The age of robotics is coming, according to CEO Jensen Huang, indicating a substantial growth opportunity for Nvidia in this quickly growing area. Furthermore, Nvidia is developing multimodal AI with an emphasis on processing image, video, and sensory input, which may open up new possibilities for AI applications. With the shift from conventional CPU-based computing to AI-driven machine learning workloads expected to pick up speed, Nvidia has a sizable addressable market going forward. As data centers develop to accommodate AI models and training, the company's GPUs will play a crucial role in powering the upcoming generation of data centers. Machine learning and artificial intelligence are predicted to play a major role in the expansion of the global data center market, which is predicted to surpass several $1 trillion by 2030. Nvidia plays a crucial part in this change, and its dominance in GPUs puts the business in a strong position to take a sizable chunk of this growing industry. Over the next 4 years, Nvidia may make $1.65 trillion from the data center sector, which is expected to grow at a 59% annual pace. If the corporation keeps its current net margins, its total revenue might reach $600 billion by 2028, and its net income could reach $300 billion. Uncertainties are introduced by the move to post-training and inference scaling, though, especially in the price-sensitive inference market. Nvidia appears well-positioned to sustain its leadership in AI infrastructure in spite of these obstacles, as seen by its solid financial standing and strategic emphasis on robotics, AI, and multimodal capabilities. In conclusion, Nvidia's earnings report emphasizes its impressive financial performance and leadership in data centers and AI. However, it also raises concerns about the company's increasing reliance on CSPs, the possible slowdown in LLM pre-training, and competition challenges. Nvidia will face difficulties in sustaining high margins and controlling its pricing strategy in the changing market for AI processors, even if the firm is well-positioned for long-term development, especially given its foray into industrial AI and multimodal capabilities. High expectations are reflected in the company's present valuation of $3.6 trillion, and future growth will rely on Nvidia's capacity to maintain its momentum in a competitive environment that is changing quickly. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now let's dive into today's video. Early Friday trading saw a slight increase in Nvidia shares, which kept the stock on track for a moderate November gain as investors retreated from the tech giant's latest earnings release and evaluated its leadership position in the AI sector, as well as its overall position in the anticipated bull market for next year. Due to demand for its next-generation chips and processors, which enabled the training and inferencing of the largest AI systems in the world, Nvidia has benefited the most from the AI boom, which started with the release of OpenAI's ChatGPT chatbot in November 2022. The market capitalization of the 6 largest tech stocks has increased by $8 trillion in the last 2 years as a result of investors' large bets that AI will prove to be a game-changing technology on par with or even more so than the introduction of the internet in the late 1990s. with a market value of $3.48 trillion, which is just short of the total value of Britain's benchmark FTSE 100 index of Europe's largest companies. Nvidia has taken $2.9 trillion of that gain, transforming it from a mid-sized manufacturer of gaming chips to the most valuable company in the world. However, investors will be looking at that group's next fiscal year, which starts in February from such high altitudes, and the potential earnings for its flagship device, the Blackwell processor family, which is essentially the iPhone of artificial intelligence. The world's largest hyperscalers, including Microsoft, Amazon, Meta Platforms, and Alphabet, the parent company of Google, have an apparently endless demand for Blackwell chips because they are faster, more efficient, and consume less energy than Nvidia's traditional line of Hopper chips. According to Wall Street analysts, Blackwell sales will boost Nvidia's revenue by several billions in the fourth quarter before increasing to almost $62 billion in 2025 and $97 billion the year after. It is anticipated that the market-leading chips, which are the real engine of the AI investment theme, would yield equally significant profits. Nvidia is expected to generate gross margins in the low 70% area for the first half of next year, with a mid-70% prediction for the last 6 months, despite the expenses related to ramping up production. To put that in perspective, Nvidia announced $4.37 billion in net income for the fiscal year that concluded in January 2023, which also saw the introduction of ChatGPT. That amount is expected to increase to $102 billion by the conclusion of the following fiscal year. The fact that Nvidia shares are actually not that costly in comparison to its Magnificent Seven contemporaries, despite the anticipated growth that is factored into them, may be even more astounding. Amazon's 40.7 times multiple and Elon Musk's Tesla's astounding 136.5 times multiple are both significantly lower than Nvidia's current multiple of 46.3 times its 12-month profits outlook. Additionally, it has very low debt, making it a cash cow with plenty of space for stock buybacks that compensate investors for their longer-term thinking. According to Gimmick Credit analyst Dave Novosel, Nvidia is expected to earn $62 billion in free cash flow in the upcoming fiscal year, with about $36 billion of that amount allocated for share buybacks. Of course, that doesn't mean it's invincible, and investors have responded cautiously to its fiscal third-quarter earnings report earlier this month, which revealed a moderating profit margin and a slowing revenue growth rate, possibly accounting for the impact of trade barriers in the tech sector and tariffs anticipated under President-elect Donald Trump's incoming administration. With its end-of-January sales total of $37.5 billion, Nvidia, which only provides investors with revenue and profit projections for the upcoming quarter, exceeded Wall Street estimates by a mere 1.5%. This is comparable to predicted beats of 5% to 20% during the previous 2 years when compared to street expectations. With Trump vowing to impose high tariffs on imports from China and emerging tech-producing hubs in Mexico soon after taking office in November, Nvidia, the largest company in the world, could find itself at the center of a tech trade war between Washington and Beijing. Jay Puri, vice president of worldwide field operations at Nvidia, met with Chinese officials earlier this week, according to Reuters, as President Joe Biden prepares new tech export restrictions that could be extended under Trump and cause Beijing to retaliate by disrupting global supply chains. However, during an academic event in Hong Kong last week, CEO Jensen Huang seemed certain that his company will find a way out of the crosshairs of the trade war. But according to benchmark analyst Cody Acree, trade and performance challenges won't change his opinion of Nvidia's stock's attractive value for astute investors prepared to see past the short-term commotion. With an overweight rating and a $190 price target, Acree claims that the sell-off is a chance to invest in the most distinctive property in the business, which is crucial to the early phases of artificial intelligence, AI, changing how humans interact with technology. Pre-market trading saw Nvidia shares move 1% higher, indicating an opening bell price of $136.70 per share. This move would extend the stock's November gain to 2.9% and its fourth quarter rise to 12.5%. As of this writing, Nvidia is up more than 185% this year, making it one of the hottest stocks of 2024. It has become one of the biggest firms in the world, thanks in part to the performance of its stock price. However, as investing is more often concerned with the future, even while the semiconductor firm and its shareholders are enjoying this tremendous success, many investors are currently debating whether to buy, sell, or hold the stock going forward. To make a decision, let's examine each instance. Future demand for Nvidia's graphic processing units, GPUs, is a major selling point. The company claims that there is a strong market for its artificial intelligence, AI, chips, but it is unclear how long this disproportionate demand will last. Big cloud computing providers, AI startups, and other tech companies are competing to develop the finest AI models, which require a lot of processing power and GPUs to train. Spending for AI training, which has been the main factor driving Nvidia's GPU sales, may start to decline if these large language models, LLMs, improve sufficiently in the near future. Meanwhile, a number of businesses have been using customized AI chips with the assistance of firms like Broadcom, while Advanced Micro Devices has managed to establish a niche for itself in the inference segment of the AI infrastructure industry. Even though Nvidia leads the AI training market, a shift in demand toward inference could present additional difficulties for the company. Nvidia's stock would be a sell if these scenarios materialize, as the company's sales and earnings would probably decline. The buy case for Nvidia is also heavily reliant on future demand, even though the sell case is. Nvidia's chips are in high demand, and this demand is only expected to grow. Artificial intelligence models require exponentially more processing power and GPUs to train on as they develop and become more complex. For instance, Alphabet said that its Llama 4 LLM would require up to 10 times the processing power as Llama 3. However, xAI's Grok 3 LLM required 5 times as many GPUs for training than Grok 2. While Nvidia's clients have generally stated that their capital expenditure budgets for AI investment are increasing in 2025, Oracle previously stated that it does not anticipate a slowdown in investment on AI infrastructure in the upcoming 5 to 10 years. The company also discussed its prospects in AI inference last quarter, pointing out that it is the biggest in this field and has a sizable existing clientele. Additionally, it has begun to gain traction with enterprise and industrial clients, which it believes will be the next major wave of artificial intelligence. However, because of the extensive use of its NVDA software platform, Nvidia continues to maintain a large lead in the GPU market. In order to enable developers to program its GPUs, Nvidia developed a free software platform a long time ago. Since then, it has evolved into the industry standard that developers use to learn. In order to stay on the cutting edge of GPU technology, the company has also sped its development cycle to provide upgrades once a year, which should continue to offer it pricing power. Despite its significant gains this year, Nvidia's stock is valued attractively, and there are still prospects for the company. According to expert forecasts for 2025, it trades at a price/earnings to growth (PEG) ratio of roughly 1 and a forward price to earnings (P/E) ratio of roughly 31. PEG ratios below 1 are typically considered inexpensive, whereas growth stocks frequently fetch PEG ratios significantly higher than 1. For investors who purchased Nvidia stock in the last 2 years, booking some profits and then letting their remaining stake ride is undoubtedly a sensible strategy given the company's enormous gains over the last few years. This is simply good portfolio management at the end of the day. Investors will have time to observe how the buy and sell arguments for Nvidia develop over the ensuing years. I would cut a little and keep the remainder of the investors who bought Nvidia early. Nonetheless, I believe there is still time for new investors to participate. Nvidia is still positioned to be the largest beneficiary of this investment, and its customers' actions and comments continue to indicate that the company will be spending heavily on AI infrastructure over the coming years, at the very least. However, despite the surge in shares, the company is still reasonably valued. As always, sharing your thoughts and insights in the comments section can foster a more informed community discussion, helping everyone navigate the complexities of investing in this dynamic sector. Stay ahead of the game with the latest stock market news, data, and important updates. I share valuable insights and real-time information on my Telegram channel, ensuring you're always informed before everyone else. If you want to keep up with the fast-paced world of investing, open the description below, click the link to my Telegram channel, and join our growing community.